An invisible mistake on your earnings record could permanently shrink your Social Security checks. But that is only the first trap. Claiming age, Medicare, taxes, work income, COLA, and survivor benefits can all change what you actually keep. Let's start with the one most people never check.
Your earnings record. Social Security can underpay you for the rest of your life because of a mistake you never made. It may not be your claiming age or retirement plan. It is your earnings record, the list of wages Social Security believes you earned over your working life. And most people never question it. Why would you? The government has been tracking your earnings for decades. Taxes came out of your paycheck. W-2s were filed. The numbers should be right. But the record is only as accurate as what made it into the system. What each employer filed. What you reported if you were self-employed. Paperwork dated back 30, 40, sometimes 50 years. Old jobs. Small companies that closed. Freelance income that never landed correctly. Sometimes a whole year is simply blank. Social Security calculates your benefit from those covered earnings. The earnings are indexed for inflation. Your highest 35 years are averaged, and that average runs through a formula. A missing year pulls the average down. A year reported too low pulls the average down. And a lower average means a lower check permanently. This is why it is worth checking even if nothing feels wrong. Job changes, small employers, self-employment, old W-2s, closed businesses can all create more chances for the record to be incomplete. It can be wrong for decades without anyone checking it. Before you file, go to ssa.gov. Pull your Social Security statement and check your earnings year by year. Look for blank years. Look for years when the number is far lower than you remember. If something looks off, gather the documents, W-2s, tax returns, pay stubs, and contact Social Security before you claim. Correcting the record before the benefit is set is one conversation. Trying to fix it after you've already received the check is a very different one. Say every number on the record is correct. There is still a second way the number can come out lower than expected, and this one is not an error at all. The 35-year rule. Imagine working 30 years, retiring, and then finding out Social Security added 5 years of zero income to the average that builds your check. That may sound like a mistake. But if you have fewer than 35 covered years, that is exactly how the formula works. Most people assume Social Security looks at recent earnings, or the best years, or some average of the whole career. What it actually does is take your highest 35 years of covered earnings, adjust each one for inflation, average them, and run that average through a formula, 35 years specifically. And if those 35 years do not exist, Social Security does not just average the years you do have. It fills the missing slots with zeros. So someone with 33 years of solid earnings and 2 blank years does not get 33 strong years averaged. They get 35 years averaged, and 2 of those years counted as zero. What looks like a small missing piece can become a real reduction in your monthly check. And it is not only complete blanks. Low-earning years count too. Part-time work. Early career years when income was low, a few self-employment years where reported income was uneven. Every one of those goes into the same average. This can catch people who did nothing unusual at all. A parent who stepped out of work for a few years. Someone who built their U.S. work history later in life. A freelancer with uneven income. Or an early retiree who stopped at 58 and assumed the calculation was finished. If you are under 35 covered years, or you can see weak years in your earnings history, check whether 1 or 2 more years of work could replace a zero or a low year. 1 additional year of solid earnings can lift the benefit permanently every month for the rest of your life. If the 35 years are already strong, more work may not move the number much. But if they are not, it is worth checking before you file.
If you want retirement rules explained before they turn into expensive surprises, subscribe. Once the check is calculated, the mistakes are not just about Social Security anymore.
They can affect Medicare, taxes, work income, and the spouse who may depend on that check later, and the first place you need to look out for is Medicare. Medicare IRMAA. IRMAA feels like a Medicare problem, not a Social Security mistake. That is why people miss it. It is the income-related monthly adjustment amount and a surcharge that can raise Medicare Part B and Part D premiums for retirees above certain income levels. The strange part is how Medicare decides what you owe. It does not usually look at what you are earning right now. It looks at your tax return from 2 years ago. So a financial decision you make today can change your Medicare premium 2 years from now. By the time the bill arrives, the decision that caused it may feel like old news. Maybe you do a large Roth conversion the year before Medicare begins. Maybe you pull a significant amount from a traditional IRA. Both can be reasonable moves. But if that income pushes you over an IRMAA threshold, a higher Medicare premium can show up 2 years later. That time delay is what makes the mistake so easy to miss. And it does not stop with one-time moves. Once required minimum distributions begin, the issue can repeat every year. Those forced withdrawals increase the income number Medicare uses later, even if you did not need the money for spending. If a large withdrawal or conversion is optional, check whether spreading it across 2 or 3 years could keep you under the threshold. Sometimes the income spike is worth it anyway. But knowing the Medicare cost before you make money decision is very different from finding out after the premium has increased. Social Security does not only interact with Medicare. In married households, the most detrimental decision is often something that looks completely fine for years, right up until one spouse is gone. Spousal, survivor, and divorce benefits. For years, 2 checks may land every month and nothing looks broken. Then, one spouse dies, 1 check stops, and the survivor discovers that a claiming decision from years ago has become their income floor. Most people have 3 beliefs about this. Married means the spouse gets half. Divorced means there is nothing left to claim. Survivor benefits work basically the same as spousal benefits. All 3 are wrong and cause real damage. A spousal benefit applies while both spouses are alive. A survivor benefit is what the remaining spouse may receive after the other dies. These are not the same rules, they do not have the same timing, and they are not calculated the same way. Divorced benefits are another place where people leave money unclaimed because the rule feels awkward. Take someone who has been married for at least 10 years, divorced, and is now 62 or older. They may assume the ex-spouse's record is none of their business anymore. But if they are unmarried and their own benefit is lower, Social Security may allow a divorced spouse benefit based on the ex-spouse's record. Don't worry, your ex doesn't need to approve it, and it doesn't affect their own benefit. The survivor version has its own rules. A divorced surviving spouse may be eligible as early as age 60, or age 50 to 59 if disabled, if the marriage lasted at least 10 years and the remarriage rules are met. So divorce does not automatically erase the Social Security connection. It changes which rule applies. For married couples, this is where the mistake can become expensive. When the first spouse dies, the household does not keep both Social Security checks. It only keeps the larger one. So the higher earner's claiming age is not just a personal decision. It may also set the floor for whatever the surviving spouse has to live on later. A couple may claim early because the combined check looks good while they are both healthy. And for years, nothing looks wrong. Then one spouse dies, and the survivor is left with a check that was claimed years earlier by a decision that only considered 2 incomes instead of 1. I covered the surviving spouse rule in more detail in a separate video, so I will link that one below. For this video, the key point is simple. Do not assume married, divorced, and widowed all point to the same Social Security rule. They do not. Before anyone files, run the numbers 2 ways. What does income look like while both spouses are alive? And what does it look like after the first death? If cash flow seems low with only 1 check, the higher earner claim late can be one of the most beneficial moves in the whole plan. The survivor benefit amount will also depend on the surviving spouse's age and when they file, so the details are specific to each household. Understanding the benefit category is one layer. How people actually pick their claiming age is a different problem entirely. The claiming age shortcut. 65 is not full retirement age. For anyone born in 1960 or later, full retirement age is 67. 65 stuck in the cultural memory because that is roughly when Medicare begins. Different program, different schedule, different set of rules. Confuse the two, and someone can claim 2 years earlier than they intended with a permanent reduction they never planned for. Most people pick a claiming age not because they calculated it, but because it feels right. 62 because it is the first day they can. 67 because it sounds official. 70 because someone told them to wait as long as possible, or whatever date a break-even calculator comes up with. Full retirement age is not a recommendation. It is the reference point the formula uses to calculate what gets added and taken away. Each age comes with a real trade-off. Claiming at 62 locks in a permanent reduction, but for a lot of people, it may still be the right call. They have worked long enough and decided to travel while they are still healthy. They may need the extra income. There are all sorts of valid reasons. It is just important to know what the reduction actually is before accepting it. Waiting until 70 can increase your benefit significantly, but getting there requires income from somewhere else in the meantime. If waiting means draining savings too aggressively, that creates a different kind of problem. Neither end of the range is automatically right or wrong. What makes the decision go sideways is choosing an age based on a feeling, a rumor, or a calculation that did not include the full household picture. Budget, health, family history, whether work continues, the spouse's situation, what bridges the income if delaying. A break-even calculator can help, but it should not be the whole decision. And there is another reason early claiming can cost more than people expect. The annual COLA does not erase the smaller starting check. COLA. People who claim early sometimes comfort themselves with this idea. The annual cost of living adjustments will close the gap over time. The smaller starting check will eventually catch up. It sounds reasonable, but the COLA does not work that way. Cost of living adjustment is a percentage applied to the benefit already locked in. It lifts whatever base was set at the time of claiming. It does not reset it. Someone who claimed early and locked in a lower starting amount gets every future COLA applied to that lower number. Someone who waited and locked in a higher amount gets the same percentage applied to a larger number. Both checks rise. The lower one does not close the distance. It keeps compounding from a smaller base, which means in dollar terms, the gap can grow rather than shrink. Think of it this way: give two people the same annual raise as a percentage. The one starting from the higher salary pulls further ahead in actual dollars every year, not closer together. When comparing claiming ages, compare actual projected dollar amounts at 75, 80, and 85. Not the general reassurance that benefits keep up with inflation. They do, but both checks get that adjustment. What differs is the number the raise is being applied to. SSA.gov has a benefit estimator that shows projected amounts at different claiming ages. Use it to look at the real numbers across the years where the check matters most, not just in year one when the difference is easiest to overlook. If someone plans to keep working after claiming, there is another rule that can start shaving the check before full retirement age is even reached. The earnings test. Claiming Social Security early and continuing to work sounds like a reasonable plan. Bring both the paycheck and the check. The problem is that Social Security has a rule specifically for this situation, and a lot of people find out about it only after the check is smaller than expected. If you claim before full retirement age and your earnings exceed the annual limit, Social Security can withhold part of your benefit. Always use the current year's number before you file. Using 2026 as an example, if you are under full retirement age for the full year, the earnings limit is $24,480. Above that, Social Security withholds $1 for every $2 you earn over the limit. So if you earn $34,480, that is $10,000 over the limit. Social Security may withhold about $5,000 of benefits. That is not a small amount if your monthly budget was built around the full check arriving. In the year you reach full retirement age, the rule is more generous. In 2026, the limit is $65,160, and Social Security withholds $1 for every $3 over the limit. It only counts earnings before the month you reach full retirement age. Once you reach full retirement age, the earnings test goes away. Here is where people get caught. Someone retires at 62, picks up consulting work, and builds a monthly budget around both the Social Security check and the work income. The work goes better than expected. Earnings cross the limit. A portion of the benefit gets held back. Nothing illegal happened. The two incomes simply interacted in a way they did not plan for. The withheld amount is not gone forever. When full retirement age arrives, Social Security recalculates the benefit to credit the months that were withheld, adjusting the reduction factors from when the claim was originally filed. So yes, it comes back later as a higher monthly check, not as a lump sum right when the cash flow problem is happening. Before filing, get an honest estimate of what earnings will look like through full retirement age. If they are likely to cross the limit, coordinate the claim date with the work plan. This is especially important for semi-retirees, consultants, part-time workers, and anyone who thinks of themselves as mostly retired but not fully done working. Now, even if the check is calculated correctly, the claiming age makes sense and work does not reduce it, there is still one more place Social Security can surprise people: the tax return. Social Security and taxes. Most people assume Social Security arrives tax-free. You paid into it your whole working life, the thinking goes. At least you get it back without another cut. That assumption is wrong for many retirees, and the income level that triggers the tax is often lower than people expect. Whether Social Security is taxable depends on something called provisional income. In plain English, it is the income picture around the benefit: adjusted gross income, tax-exempt interest, and half of the Social Security benefit itself. The more income you have from other sources in retirement, the more of your Social Security benefit may become taxable. In some cases, up to 85% of the benefit can be subject to ordinary income tax. Not 85% taken away. 85% counted as taxable income. The income that pushes people into this territory is often what they were already planning for: IRA withdrawals, 401k distributions, pension income, part-time wages, dividends, capital gains, and later, required minimum distributions. Every one of those can raise provisional income, which can raise how much of Social Security gets counted as taxable. A retiree takes a larger than usual IRA withdrawal one year. That pushes provisional income higher. Now, more of the Social Security benefit may be taxable on top of the tax already owed on the withdrawal itself. And if that same income spike crosses an IRMAA threshold, Medicare may respond 2 years later with higher premiums. One decision can affect 3 things at once: the tax on the withdrawal, the tax you pay on Social Security, and the Medicare premium 2 years later. That is the surprising part for people who planned carefully in every other direction. They looked at each account separately, but never modeled what happens when the income all runs through the same tax return. Claiming and withdrawal are not 2 separate decisions. They are part of the same retirement income plan. Before claiming, run an estimate of what provisional income may look like in the first few years of retirement. Think about when Social Security starts, when IRA or 401k withdrawals begin, whether part-time work is continuing, and whether a Roth conversion or large withdrawal is planned in the same window. It is not about making every year perfectly optimized. It is about avoiding the surprise where one income source changes the cost of another. Most people treat Social Security as one question: what age gives me the biggest benefit? Pick an age, run the break-even math, done. But by now, you can see why that question is incomplete. The claiming age only matters after the benefit itself is right. The 35-year formula is understood, the spouse's future income is protected, the work rules are accounted for, and the tax and Medicare interactions are not being ignored.
So before you file, do not just ask, when should I claim? Ask, what happens around this check? Because Social Security does not arrive alone. It lands inside a tax return, a Medicare premium, a work plan, and sometimes a survivor's future income. The expensive surprises usually come from the rules attached. And nobody explained that before you filed. I am Allison. I read the fine print so you don't have to.
I'll see you in the next one.